The funding and ROI worksheet is a critical part of the business case. It's where the return on investment calculations are done. So let's take a look at how the worksheet does that. There are 3 sections to this worksheet. The top part is how much money, how much capital, how much funding is required for the project. The second part gives you a chance to indicate what sources of that funding might be. And the third part is where the return on investment calculations are done, using the above information as well as information from other worksheets. So let's go back up to the top, take a look at the upfront funds required. And you'll notice that there are a number of line items that might be relevant for this particular project. In our case, there are 2 in particular that look like we should pay attention to. The cost of climate proofing company facilities and other retrofits. This is a retrofit. And there may be some new systems or processes that need to be associated with the operation of the building, so there may be some money there. So after we complete this, the worksheet might look like this. And of course, as usual, we would check these numbers with the operations and the real estate people to make sure that they agree that those are reasonable estimates. And then we go down and take a look at the sources of funds. And the worksheet automatically assumes that the company is going to have to use whatever approach it normally uses for capital expenditure investments. So we're assuming that the entire cost, the $9 million, is going to be done that way. If, on the other hand, you can get some government assistance or other impact investors or other clever ways of doing financing, you could allow for those and subtract those amounts from this, so that the balance is still $9 million. So basically what you're trying to do is to show where the money comes from. So now we're ready to do some calculations on what the overall return on investment is for the money that we require to do the project. So let's scroll down and take a look at that. You'll notice that the benefits have been mapped out over 5 years to show that they will be actually realized gradually. You can change that to 3, 4, 10 years if your finance people prefer a different time horizon, but 5 years is a pretty good time frame to start with. Also, there's a built-in assumption that 50% of the benefits are realized in the first year, 80% in the second year, 100% in years 3, 4, and 5. If you want to change those assumptions to something different, just overwrite those formulas in those cells. You'll notice there are quite a number of purple cells here. That means you don't have to figure them out, they're done for you. If you want to understand the formulas in the calculation cells, Appendix D, the ROI calculations, explains them. So Appendix D, you get to that by going over here. Actually, it's not Appendix D, it's Appendix B. And Appendix B has all of the excruciating detail behind how these calculations are done using an example, which is at the top, and then payback period and the logic that is in the formulas that are being used in the payback period. And all of these formulas would be good to check with your finance folks, so that they agree that the way in which the worksheet is doing these calculations on payback, internal rate of return, net present value, is the way in which they would normally make those calculations themselves. And if there's any difference between the way the worksheet's doing it and the way they do it, change the worksheet to agree with the way they do it. They are in the driver's seat on how these calculations should be done. This is just sort of a general starter set on how they might be done as well. So let's go back to the funding and ROI worksheet and explore this a bit more. So the nice thing about these calculations is that they're done for you. All of these totals that have to do with the previous worksheets are automatically populated in there. The assumption about these 50, 80, 100% are done and applied to those amounts so that you can see the way in which they gradually build to the full amount. The overall normal cash flow is done as a calculation. And then the return on investment calculations, the IRR, the payback period, the net present value calculations are all done using the built-in formulas. And it gives you a chance to do a reasonableness check on whether this looks reasonable to you or not. in conjunction with the finance folks who also have lots of experience here. The nice thing is that the payback period for this particular project, using all of the numbers that we've been able to derive previously, is a little bit over a half year, which is pretty good. So that kind of reasonableness check is good to do, and also is a good thing to engage some of the other folks in your company in taking a look at, especially the finance folks. As usual, as with the other worksheets, all of the results of this have been automatically entered into the CapEx request template by Excel, so all of those numbers from the last worksheet are there now as well. So that's a quick overview of the Funding and ROI worksheet, which is really the heart of the whole workbook. It gives you a chance to estimate how much money you need for the project, where that money is coming from, and how this is going to be a good project, good return on investment for the company to undertake.